Good morning, everybody. Thanks for coming along to the JLL webinar this morning on financial planning. My name is Jonathan Sheehan.
Hi, my name is Robert Smith, and I'm a portfolio manager here at Well.
Yeah, so thanks to all of you for coming along this morning. You would have seen from the circular that this is the first of 7 weeks, 7 Fridays, and we're going to cover 6 different areas of financial planning over the next 6 weeks. And the purpose of today is to speak about financial planning at a high level and discuss the different modules for the next 6 weeks and give you an overview of the do's and don'ts and the high level financial planning considerations for you and your family. So very much looking forward to the next 6 weeks. Thanks to JLL for giving us this opportunity. And I'm just going to bring up my slides. So just a few housekeeping. Firstly, we'd love for you to ask as many questions as possible. We really would encourage you to submit questions through the questions and answers button. There's also a chat button. If you submit anything to the chat, everybody can see it, but the Q&A button, it's just Robert and myself will see the questions. So as we go, you can ask those questions to us. And even now, if you don't mind, if you wouldn't mind just submitting question just through the Q&A button, just to get you used to using the button itself, and so that Robert and I can see the notifications coming in. Yeah, there's a couple coming in there. So just, yeah, question. Thanks very much for that. Just type, yeah, test or hello or good morning or whatever it is. Yeah, that's great. Okay, so yeah, that's super. So that's all working great. Thanks very much for that. So now we have you in the habit of asking questions. So please do ask as much questions as possible. They're all anonymous through the Q&A tab, and Robert and I will answer them hopefully as we go. This session will be recorded, so we will send out the recording afterwards. And also all of the slides that we're doing will also be sent out in PDF form afterwards. Okay, so I'm the Managing Director of Compass Financial Planning. Our office is probably about a 4-minute walk from JLL's office there in Hatch Street. We're on Upper Pembroke Street in the Leeson Street end. There's 4 of us in the business, joined by my colleague Robert, who you saw there a minute ago, and we just specialize in financial planning for individuals and families. So everything we're talking about over the next 7 weeks is something that we're passionate about and we look at all the time. So we really look forward to educating you guys as much as possible. So here is the agenda. Today is the introductory module, and over the next 6 weeks, we're covering off 6 different areas in no particular order, really, but hopefully the cash flow planning, which is the first module next week, will really frame the infrastructure and the future modules because of what we'll discuss in the cash flow planning webinar. Just to give you a sneak preview of each, cash flow planning for individuals, we're going to speak about outgoings analysis. So how do you keep on track of your spending? How do you categorize your spending? There's different types of outgoings. How do we look at our gross income, our net income? So your cash flow position is really your net income versus your outgoings. We're going to give you some tips so that by the end of that session, hopefully you'll be very clear on what your cash flow position is as an individual or a couple or a family or whatever it might be. And then that'll help you then set financial budgets into the future. So looking at your income, your outgoings, and saying, well, this is the current position over the last 12 months. What do we project 12, 24, 36 months in advance? Second module, retirement planning and pensions. There's a great expression, short-term pain for long-term gain. And you need to look after your future self. And that's what a pension is. It's not tangible. It's years in the future. Retirement planning and pensions is not exciting. It's not interesting to a lot of people. Trust me, because we look after clients all the way up until their 80s, all the way down to their 30s. The people in their 60s and 70s and 80s who made financial decisions in their 30s and 40s and 50s to look after the pension are in a better financial position, and therefore, all else being equal, have a happier retirement than those who neglected to look after their pensions. So we're going to speak about funding a pension. Within JLL, you've got a great group pension scheme in place. So the account is there, the pension is set up. You don't need to set up your own personal pension. You don't have too many decisions to make. You've got a scheme that's already in place with the employer contributing in. So you have the structure, so use it. We're going to speak about retirement planning. When you get to your 50s and early 60s, you need to start looking at, okay, how am I going to exit? What am I going to retire on? How is that going to look? And we're also going to give you an overview of what pensions are. There's a lot of moving parts, pensions, but we're going to simplify it as much as possible. In the third module, we're going to speak about protection. Do I need life cover? Thankfully, within JLL, there is life cover in place already, which is very, very useful to have. So it reduces the need for you guys to go to a broker or an insurance company to take out your own personal life cover. So you're piggybacking on the group cover. But still, if you take down a mortgage, you're going to need mortgage protection. And depending on your financial dependence, so if you've got children or a spouse who are financially dependent on you, you might actually need more life cover. And it depends on your age and your health status and all that. We'll speak about life cover, the different types of life cover, and also income protection and the different types of protection policies, such as serious illness cover. And the fourth module is going to be on tax. So 3 key points: what the tax rates are in Ireland, what level of tax you pay on your income, both earned income within JLL, but also any other types of income or capital profits that you make. We speak about not just income tax, but capital tax, which is capital tax or CGT, capital gains tax, or inheritance tax, or gift tax and things like that. You can gift 3,000 per annum to third-party beneficiaries or your children, whatever it is. We'll speak about that. And also, on a practical basis, how to manage your tax affairs. The good news is when you're an employee of a company, of a big company like JLL, a lot of that work is done for you through payroll, because you get paid at source, and at source, tax is paid directly to revenue on your behalf. So a lot of the work is taken away from you, which is great, but there's other affairs, tax affairs you need to be aware of, which we'll also discuss. Investing. So the 3 key points are, we'll speak about investment markets, what our view is on asset classes, equities, bonds. Obviously, you guys know a lot about property, but we'll speak about markets generally and the asset class options. There's a fundamental theory of risk return. So if you put your money into on post, you're taking no risk, but you get no return. If you put your money into a high risk speculative equity or shares in Tesla or Ryanair, whatever it is, you're taking a lot of risk, and you should be hopefully compensated for that by a higher return. But we'll speak about risk return and the difference between investing and speculating in other non-regulated assets like cryptocurrency and that type of thing, which we'll touch on in that module. And also just what the general options available to you are. In the last module, we're going to speak about mortgages and debt. We're going to speak about when I should borrow, when I should not borrow, interest rates and the cost of borrowing, and also what the central bank rules are at the moment. And we saw yesterday that the ECB announced an increase in interest rates from July by 0.25%. So ECB base rates are going to be going up, therefore you can assume, and already the variable rate, mortgage rates and fixed term rates are all going to go up. And if you're on an existing tracker rate, for example, that's going to start going up as well soon. So the mortgages and debt will be joined by my brother actually down in Cork, mymortgages.ie, and we'll be doing a Q&A with them on mortgages. So that will really, really be interesting, regardless of whether you have a mortgage or you're looking to switch mortgages or whatever it is. We'd definitely recommend you'll attend that module, along with all the modules, obviously, needless to say. Okay, so why do we need financial planning? Because it helps your ability to save, saving for the long term. Remember, short-term pain, long-term gain. Spend less now, enjoy your retirement in the future. You want to make sure your standard of living in retirement is adequate. We're used to hopefully an enjoyable time while we're working. But if you retire, your income, your earned income will cease. So you need to pivot onto passive income or pension income. But you want to make sure that you're not holding back in your retirement, that you enjoy your retirement. That might mean working a bit longer or building up, making more financial sacrifices now to enjoy your retirement. Buying a home is important. You might already have a home, but you might say, God, I'd like to upgrade. That's also an important consideration for anybody. You need to make sure your lifestyle is financially viable. You want to be able to provide for yourself and your family. So if you've got financial dependents, children, potentially grandchildren in due course, you want to make sure that potentially you can look after them financially and helping them out with college or school or Erasmus or whatever it might be. So you need to set budgets for that as well. And healthcare is very important because as we get older, obviously our need for healthcare will increase. And we know what the healthcare VHI and all that type of thing costs. But as you get older, there is going to be a need for more and more cost. And obviously nursing home is the obvious one. But having enough money so you don't have to worry about healthcare costs is very important for people. This is what we call the capital arc, that actually in your working years, you want to accumulate your capital, and ultimately in retirement, ultimately you'll be decumulating your capital and drawing down your income so that you can enjoy your retirement. And that's really what this is all about. People in their 20s and 30s, I'm conscious on this call here with JLL that there's people varying in ranges from the 20s right up until their 60s. So you'll find that your financial needs will differ depending on your age profile. So in your 20s or 30s, your priority is probably just saving and earning and potentially funding a home purchase. Once you get towards your mid 30s, late 40s, you might start looking to invest a bit, manage your cash flows a bit better, but depending on what your mortgage situation is, and really start considering maximizing your pension contributions. We skip on then to your 50s, your 60s, moving into your late 50s. At that stage, all else being equal, your career trajectory should be peaking and your earned income, your salary should be higher than it was in previous generations or decades. Your loans should be reducing because if you have a mortgage, you're paying down principal every month or every year. So your capital position is improving because your loans are reducing. You're more and more focusing on your retirement. Every year you get closer to 65 or whatever it is. And if you've got children or potentially grandchildren coming, you're going to be looking at succession planning. And then in retirement, which could be from 60 or 65 or 70 or 75, or whatever it might be, you start looking at, okay, my earned income is now gone. So I'm now looking at my pension income, my risk reduction, and my estate planning. So at this stage, if anybody has any questions or comments, now that you're used to using the Q&A button, please just submit them. We'll be answering them as we go. Just take a break and submit any comments or questions through the Q&A tab. And while you're thinking about that, here is some areas, some questions we get asked from time to time. Obviously, we'll be sending these slides afterwards so you can read these back in your own time. So these are just common questions that hopefully by the end of this, we'll be in a position to share with you what the answers and the solutions are to the common questions that you have. So what we're going to do now at this stage is we're going to run a quick poll, if that's okay. I'm just going to share this poll with you. So the question is, what areas of financial planning is most relevant for you? And you can choose one of these options. So of all the different modules we're looking at, which area do you believe is the most relevant? Lots of answers coming in, so keep them coming in, that's great. Okay, this is all very good to know. Okay, nearly everybody has put in an answer. Okay, we'll give it another few seconds and people can submit their answers. Okay, so that's great. Thanks for that feedback. I'm going to share the results now. So this is interesting. The most relevant topic is pensions and retirement planning. And as a admittedly pensions nerd. This is very good for me to hear. So 29% see pensions and retirement planning as the most important, followed by cash flow planning, which we'll discuss next week. Mortgages and debt next at 23%. And then a bit less relevant is investing, personal tax. So that's good to know. So thanks for that. So now I'm going to pass on to Robert, my colleague, and he's going to speak about financial planning and the 3 priorities.
Thanks, Jonathan. I think the poll is very interesting, especially your colleagues this morning voted quite differently from yourselves. They were far more interested in cash flow planning and less so in pensions and more in investments. That may have to do with perhaps different age groups here with us today. I'm not sure, but it's very interesting to see the poll results. Thanks, Jonathan, for that too. So just in terms of myself, I'm going to be chatting to you about financial planning and the priorities in which you lay out your financial plans and how you should ideally lay them out, irrespective of age or irrespective of stage in life. The first one is obviously to understand your current financial position. And this can be looked at through 2 levels. The first one is through your capital position, which means your assets and your liabilities. So in order to understand and explain that, what are your assets and what are your current liabilities? So your assets, just for examples, it can be many things, but your home, perhaps as an asset, it could be your pensions, your investments, they will be assets or classified as assets. In terms of liabilities, it's anything in which you owe someone something. So that could be credit card loans, it could be bank loans. For most people, it's still a mortgage repayments at that point, or at this point, your home is still considered a liability. If you're making mortgage payments, that's considered a liability. So it's about really ascertaining what are your current assets, what are your current liabilities, quantifying those, writing them down, seeing them visually in front of you, understanding them. As you can see from the bullet points there, your profile of assets can be very different. So assets take a different form in our field in terms of investments and pensions. We'd be looking at assets too in another way through the prism of funds you would own. And then we'd be looking at your asset splits. So how are those funds split? How much do you have allocated in each area of your investment or your pension, as you'll well see from your valuations? Your liquidity profile. So how much do you have to readily avail of in terms of cash? Are you able to quickly move out of a position, or how much do you hold in cash? How quickly can you have access to your funds? And the geographical spread of your assets. So this may be tangible, something physically you can touch, like a home or a rental property, for example. What's the geographical spread of that? Is there a home overseas? Or do you have a property here in Ireland? Do you have numerous properties? Understanding your geographical spread, your geographical risk, and then the asset allocation ties back in with the asset class split, really. How much of your portfolio is allocated into which area? And is it properly allocated for you at this point in your life, with your obligations, with your needs, with your desires? Is it structured properly for yourself? And then a schedule of all loans and liabilities, understanding that and the value of your pensions. The second is cash flow planning, which is income and outgoings, incredibly important. Once you understand your capital position, that you understand your cash flow. So what are your incomes? What is your income or incomes, and what are your outgoings? We can all calculate our outgoings very quickly. Our income is normally quite easily attained. For most people, we have one source of income. For some people, we have 2 or 3 sources of income, but it's the balance between both, understanding the gross and net income from all sources. And we split the outgoings into 2 areas. Mainly to simplify the process, we would look at essentials and discretionary spending. Your essentials, as you can see, are your mortgages, your utility bills, childcare, education, household expenses. These are things you must pay to maintain your current life as is and to maintain your future life goals. And obviously your discretionary spending, something that a lot of people struggle with. And it's always the main bugbear of anyone we chat to, is understanding how to balance your holidays, your cars, your restaurants, your socializing, your hobbies against your essentials. Are you getting that balance right for you at this moment in time? Once you understand your first priority, your second priority comes into focus, which is deciding on your financial goals, your objectives, your preferences, your concerns. This is very much individual, as well as a pattern that you can follow. It is an individual task to undertake. We'll just move up the next section there for you. So it's really, there's numerous things you can look at when making these decisions. Your target retirement age is very important. For most people, that's 65. For others, it may be different. So that will dictate your planning, your goals, and it should. Your desired income in retirement is very important. Just touching back on what Jonathan said earlier, your income can definitely, it will definitely fall lower in your retirement years than it does currently. If you're at a certain stage of life, especially in the 10, 15 years prior to retirement, you've become accustomed to a certain lifestyle, you've expanded as your salary has expanded, as your comfort has expanded, you've reached a certain lifestyle for yourself, but that will alter in retirement. And it's very important to be realistic as you're at that point in your life as to your current level of spending, and to have that in mind as you move into the next decades of your life, especially in retirement. You'll be deciding what type of home you may want to have. What are your main financial concerns and fears? These are very important to write down, to understand, to see in front of you, discuss with your family members, just get a feel for what are your concerns. Are you looking after loved ones? Is it parents? Is it healthcare issues that you may have yourself perhaps, or is it multiple intangibles of these? I'll move on to the next point. Succession planning is very important for the next generation. So that's looking after if you have children or you have siblings even. How are you planning for them to pass your current assets on to them? Have you even thought about this? Is this something you should be thinking about at this stage in life? I would say yes at all stages, because we just don't know what's around the corner, and that's what financial planning is about. Investing preferences and restrictions. So what is your own tolerance to risk? How do you like to invest? What are you interested in? What do you understand? What would you like to discuss? So there's so many elements to that. And again, that's something that can happen with a financial planner, and something you can have with your family initially, but then take to a further stage. In terms of ideal discretionary spending, what is your best budget for you and your household? Again, very much individualistic. It may be the case that you need to review that and just see, do you have too much discretionary spending? And is that balancing out on your fixed overheads, your essentials, and vice versa? And then finally, budgeting for specific one-off events. They will always come by in life, like weddings, or you may have a cruise or a trip you want to take that you've always wanted to partake in. That will have to be looked at and assessed. And does it fit into your current financial circumstances and goals? When you figure out priority 1 and 2, you move on to priority 3, which is to make the most appropriate financial decisions based on priority 1 and 2. And as Jonathan said, these slides will be circulated. I know this is a lot to take in at the moment. So as we go through, you allocate capital specific to your needs. So it's very important that once you make those decisions and you said that this is the right course of action for me, that you then allocate capital to those needs in order of priority. And we'll discuss that a little bit more in a moment. That you have a nest egg and an emergency fund. Normally, we would say anything from 6 to 12 months income set aside at all times. A rainy day fund, an emergency fund, always have set aside. Now, I know that for some people that's easier said than done, especially in this environment at the moment, but that is your ideal goal and where you should really try to aim to be in terms of your own personal finances. Pay down your loan expenses, which is very important. Obviously, those which are the highest interest bearing first. And if the option is there to do so, you should aim to pay those down immediately, and everything else starts to simplify from the back of that in terms of your other loans and expenses. Maximize your pension contributions is very important, because as you get older, the great benefit of having a pension is that you can contribute more and have more tax relief on your contributions. So as you're reaching peak in terms of your income, it's actually a wonderful time to contribute more and gain more tax relief. So it's a win-win for someone, let's say in their 40s, 50s, and approaching their 60s. And lastly, to allocate capital to home improvements, that may be something you may want to do. And again, factoring it in. As we move across to the second side of the screen, you can see you can increase or decrease your outgoings. You need to consider your retirement age. Minimizing tax to maximize net income. That can be done through various means, and that will be discussed in the modules to come. Over the coming weeks, we have a specific module on tax planning, and protection for you and your family is very important. I know at JLL you have a level of protection in place, but that's something that's absolutely key in terms of whether it be income protection or life protection, that you have those in place, because that actually plays off as a catapult to all other aspects in your life, including pension and investment planning and so on. And lastly, succession planning for your children. As Jonathan said, looking at the longer term, thinking bigger, thinking beyond where you are today, the next decade, the decade beyond. What are you doing to look after those who are coming after you? Thanks very much for your time.
Thanks, Robert. That's very, very useful there. So I think the key point that Robert was making was that regardless of your age, of the value of your assets, of the level of your income, irrespective of that, the same consistent process applies. When you're looking at your finances, you have to firstly understand your current position, capital and cash flows. If you can't measure it, you can't manage it. So before you make any decisions on a house or mortgage or buying this or spending that or whatever it might be, you need to make sure you understand your current position. Once you have that cash flow and capital base documented and you're familiar with where you're at, then you say, okay, what would I like to do? When would I like to retire? Do I want to buy a new car? Do I want to do the work to the kitchen that I've been putting off for years? Do we want to go on an extended holiday? Do we want to do whatever it might be? You need then to ascertain what your dreams are. I understand for a 30-year-old, it's very hard to figure out, do you want to retire at 60 or 65 or 70? But actually for a 55 or 60-year-old, that decision is a lot easier to make because you're closer to it. So you need to make the right financial decisions. You know, a very simple one for someone below the age of 35 is, do I want to buy a house and when, and do I want to buy a just about affordable house, or do I want to go extra, whatever it might be. So you need to look at those. And then the third one is to say, okay, what do I want? What decisions do I want to make? What are the most appropriate financial planning decisions given my existing situation and given where I am in terms of what my objectives and goals are? We're just going to do another poll now. So a very simple question. Do you review your finances at least once per year? Yes or no? So the answers here will be interesting. Obviously, what we're trying to say to you, and we will say to you over the next 7 weeks, we'll probably mention it in every single module, is that you should sit down at least once a year and spend a good deal of time to understand all of your finances and do your budgets and tot up all your assets and figure out what your plans are. January is usually the best time for this, but also September after the summer and when, you know, back to school and that type of thing. So, you know, in terms of the timing of this, we'd suggest that the last module is towards the end of July, and a lot of people kind of kick back a bit in August, but starting in September to sit down with your spouse or your family or whatever, yourself or whatever it is, and do your personal finances. So just to share the results of that poll, so it's 50-50. So half of you are doing your homework every year, which is good to hear and well done. And the other half are yet to do it. So hopefully by the end of these 7 modules, the vast majority will be sitting down once a year. And that's ultimately what myself and Robert's objective is from this exercise. We want you guys to understand the importance of personal financial planning and spend the time yourselves doing it in due course. Okay, so it's worth noting the economy at the moment. It's probably the least exciting part of this webinar, frankly, but the economic background, which is out of our control as individuals, but it does dictate planning. So I think it is worth noting here. I'm just going to speak firstly on a global level. So there's political turmoil, as we know at the moment globally. We're well aware of what's happening in Russia, Ukraine. We've got, you know, the elections in France recently. We've got Boris in the UK. We've got Trump, ex-Trump, now Biden, and potentially, you know, midterms coming up, potentially the Republicans and Trump getting back in due course. So politically, there's a lot happening in the macro environment. There's huge supply chain issues at the moment globally, which is very, very detrimental for inflation. It's all as a result of what's happening in Russia, Ukraine, but also as a hangover from COVID and lockdown still in China. We do have, you know, we feel as though we're out of the woods in Ireland with COVID, but actually China, as I said earlier, has just come out of a lockdown, and that's having an impact globally and global economics still to this day. Rising commodity prices has a direct impact on your outgoings. There's no doubt about it. The cost of commodities, be it foods, be it minerals, be it oil and gas, whatever it is, has a direct and indirect impact on your pocket. So it's very important to be conscious of it. It's out of your control, so I wouldn't stress about it too much, but you do need to figure out how it's impacting on your outgoings and make decisions accordingly. inflation in Ireland at the moment is up at 8%, and it's probably going to get to double digits. So what that means is that on a 12-month basis, all else being equal, the price of goods and services is 8% higher in Ireland now than it was 12 months ago. Energy costs are about 25% higher. Certain things like technology are only 1 or 2% higher. But it means that if you're traveling every day, or if you've got a D or an E energy rated house and it's a big house with surplus space, your energy bills are going to be significantly higher. Your cost of living might be 20% up in last year. Whereas for other people who maybe are renting and their rents are capped at 2%, and they're in a new apartment and their energy ratings, their energy hasn't been as increased as much, your inflation rate might be a bit lower, but all else being equal, inflation has increased substantially in Ireland over the last 12 months. And there's a lot of talks of recession coming down the line as well. Locally in Ireland, we're seeing housing shortages. Obviously, JLL are more familiar with that. As I said, the cost of living is increasing. We're seeing gas and diesel and petrol increasing, the pain at the pump. But ironically, the Irish economy is actually very strong in terms of GDP figures. There's reduced competition in banking. That's very relevant for you guys because the likes of KBC and Ulster Bank, as you know, are leaving Ireland. So it's bad in that the less competition, the less competitive mortgage rates are going to be in Ireland, and the less competitive deposit rates are going to be as well. So we hope as consumers and as a financial advisor, I want to see more banks come to the Irish market. But for regulatory reasons and Ireland being a very small economy, it's actually a lot more difficult because they can just go to different jurisdictions and have access to more people and less regulation. So it's a challenge the government have. And unemployment rates are very, very low at the moment, which is a good thing for society. It's good for you guys. It's good for everybody that there are jobs out there, but it is a challenge because it just means that there's more of a pressure on inflation and there's more of a pressure on employers and therefore company profitability, which might be negative for share prices and your pension funds indirectly. So now I'm just going to hand back to Robert, and what he's going to speak about is the interdependency of the 6 themes that we've discussed so far.
Thanks, Jonathan. Yeah, very much so. As Jonathan previously discussed there, everything, although we're discussing everything across a level of modules, we've touched on what each one will be covering over the coming weeks. There's also a huge interdependency between these 6 modules itself and between these topics as a whole. And there's always trade-offs. I see we had a question there in the Q&A from someone who actually mentioned this very thing about saving, and we will definitely address your question later on. There's always trade-offs with every financial decision. So whether you're saving, you're having to forego certain things, or if you're going on holiday and socializing, you're having to forego savings. If you're saving, you're trying to get a home, perhaps you're finding you're entering a bidding war at the moment and you just can't afford one, or you're overpaying. Are you underpaying? At every point, there's a trade-off, there's something to consider. And that's always very important to factor in for yourselves when you're making decisions. But that's not to be in any way an impediment to you. That can be something that you can use to your advantage also, and it's something that you can use to your favor. So we will touch on that again throughout the modules. And it very much a zero-sum game. It's very much tied into that is actually tied into the trade-offs. Exactly the same meaning is that you will gain something to lose something, but what should you be prioritizing in what you gain? At what point in your life right now? Very, very important question to think about and consider, and even to seek professional advice on. In terms of capital and cash flow, they are inversely correlated. So what we mean by that is, just using an example, you may be feeling, let's say at the start of the year and towards the end of the year, you've covered 12 months, but you don't think you've gotten anywhere, or you don't think you've actually progressed financially in your goals. You don't think you've reached your targets. You've been able to save as much as you have. You didn't get the home perhaps you wanted to get this year. You'll have to wait another. What will happen then? Will there be more inflation? Will prices rise, et cetera, et cetera? And it could be many, many variables of that. It may not even be property related, but there is an inverse correlation. And the inverse correlation is that although this is all happening, let's say you do have a property at the moment, you would actually see that you have been paying down your mortgage over the last 12 months. So you're not seeing it today, but you're actually helping your future self. And the same with a pension. You're contributing to a pension. You may not see that tangibly in your pocket today, but at all times you are moving forward. So let that be a comfort for yourself, that you are taking steps to progress despite not being able to perhaps tangibly see that in front of you on a day-to-day basis. In terms of where we are, the interconnectivity, this is just a further illustration that there are different steps to financial planning, but it's the same stairs, it's the same goal. You're reaching the same target. The first step, we would always say, as we mentioned from the outset, is cash flow planning, because that steadies all other steps. Everything else happens from understanding where you are today, what's your capacity, what's your capability. Next is protection, protection of your income first and your life second. It's very important, obviously, to protect your income, because that's what funds all other aspects of your life and your existence. So income protection, often overlooked, very rarely talked about, something to discuss. And I know you have protection in place as well at various levels in JLL, so that is great. And obviously life cover being the next. Our next step is mortgages and debt, which is a logical step for most people in their lives. It's the first step on the ladder, as they say. You want to get a mortgage, you want to get a home for yourself. Often when you do, you find that your rental income drops down significantly. In this current climate with high house prices, that might be the case initially, but it will always follow later on as you're paying down that mortgage, as we discussed. It's facilitated by cash flow, obviously, too. Next, after you've achieved that goal, you really should be looking at, and I know you have that in place at the moment, is retirement planning and pensions. And you may be thinking, well, I need the funds at the moment. Perhaps depending on your age group, you may want to contribute less and you may not be thinking long-term, but it's very important to look at the long-term picture as long as you have sustainability in the current phase. So that's where retirement planning comes into place. And I know JLL look after you all in that respect. And the next step that we have on that line, once you've actually covered off the prior 4 steps, is investing. So what are you going to do with that spare capital you have, that discretionary capital, that discretionary income? What are you going to do with it? The best use of that is to actually put it into investments to get a higher yield than you get from a bank account, a higher yield than you get from perhaps on Post or somewhere else. You're seeking to invest it so it returns more for you. And lastly, personal tax, which oversees steps 4 and 5, particularly the retirement and investing element of your life, but also other areas of your lives too, is actually how do you structure your taxation so that you mitigate tax as much as possible and that you're in a position to look after your remaining funds and look after yourself. In terms of the need to see the whole picture, this is very important. This is just an illustration of what a comprehensive financial plan looks like. These are some of the elements of a comprehensive financial plan, as we touched upon already, and we will discuss them in the modules over the coming Fridays. Pensions, investments, having protection in place, understanding and having an understanding of personal tax and how that impacts the other elements, your mortgages and debt, keeping that in focus, keeping it realizable, keeping it realistic, not over borrowing, making sure that you're freeing up as much cash flow as possible to fund the other aspects of pensions, investments, and so on. Thank you very much. I'll pass you back to Jonathan now.
Thank you very much, Robert. That was very, very useful, and it was great to see the interconnectivity of all of the various financial planning steps. I suppose what I would say is that every financial decision you make, every single one, has a knock-on effect on something else. So if you say, I'm going to put the maximum into my pension every year, I would say absolutely you should do that, because you could save taxes up to 40%. But that's less money to save for a mortgage or to invest, whatever it might be. So it's important knowing the particular needs and decisions you need to make at a point in time and see how that's interconnected. So what I think a big mistake people make is that they look at financial decisions in isolation without looking at all the impacts on all the other steps. So I think that's the key point Robert was making. So there's some questions coming in here, which I'll be answering as I go, and we'll have a couple of minutes at the end for answers, but for questions and answers. So I just want to summarize some key tips from a practical point of view. Everybody should sit down and review your finances every 12 months. I would say this to an 85-year-old, a 25-year-old, a 55-year-old, every single person, whether it's you individually, you and your spouse, you and your family, whatever it might be, it has to be done. It's so important to do that. One obstruction to that is actually people getting frustrated with, I can't find my online details for this account or that account or whatever it is. We'll be suggesting just cleaning up your finances and making sure that you have online access to all your bank accounts on your phone if preferable, and also your JLL pension, any pensions you might have had before JLL. So within 5 or 10 minutes, you're able to log on to the couple of different institutions and know the value of your capital or whatever it might be. That's so, so important. So it might be just a case of saying, I'm going to get this online access sorted. It's been on the long finger for however long. It'll make it easier. Trust me on that. And that's one of the attractions to things like Revolut as well, that it's just an app on your phone. It's easy to use. So I'd also say that if you have old bank accounts that are just sitting there from when you were walking into your first day in college. I remember my first day in UCC, I walked in and I set up a free AIB account, and I think they put 20 euros or something into it. But if you have all these old credit union accounts or bank accounts, and now you're married and your partner's accounts, you have accounts, I would just close them all off if you don't need them. Like actually with Ulster Bank and KBC leaving, it's a good excuse for people to do that and minimize the amount of accounts you have, because it'll make life easier for you. And as well as that, if you've got 300 euros in an old account, the bank might be charging 25 euros a year in negative account fee, current account fees, whatever it is. So just clean all those up, make it easier to log into all these things. Track your spending. Some people are spreadsheet focused, some people are pen and paper focused, some people use Revolut, whatever it is. You need to be able to understand what you're spending every year, what your income coming in is. And my only point is, if you've got too many accounts and too much complexity, it'll make that more difficult for you. So just simplify the tools as much as possible. Understand how tax works. That's very, very important. We have a full module on tax, the fourth or fifth module. So do tune into that one along with all the other modules, obviously. Be clear on what your goals are, and what the knock-on effect is. So if you want to get a mortgage, or one of the exercises we do with clients, we say, well, what are your goals? And everybody says, I want a comfortable retirement. That's a given. But some people say, well, I don't want to wait until I'm 65 to have my mortgage paid off. I want to have it paid off by the age of 55 or whatever it is. And don't be afraid to be ambitious and have these goals in place. And understand how each area of financial planning is interdependent on all the other areas. So that's it from the slides point of view. We do have 3 or 4 or 5 minutes now for questions. I'm going to just take off the screen here. And one question that's come in there is finding it very hard to save because of the cost of everything at the moment. And obviously this person is finding it very hard to save from a cash flow point of view on a monthly and annual basis. Well, the solution there is that you need to firstly document all of your outgoings, and they get categorized into 2 bundles. And I'm preempting a lot of what we're going to speak about in 2 weeks, in 1 week's time, actually, the cash flow planning. And every outgoing you have is either essential or it's discretionary. The essential outgoings are non-negotiable. You need to keep the lights on at home, you need to pay the rent, pay the mortgage, whatever it is. But there is leeway with the discretionary outgoings. And if that outgoing is you're going to go to a wedding in Kerry and it's going to cost you this amount to travel there, and you're going to stay in the lovely 5-star hotel for 2 nights, and you're going to do all these things, you can make decisions to not go for 2 nights, go for 1 night, or go to the B&B instead of the hotel, whatever it is, yourself what these are. But the solution to reducing costs ultimately is discretionary costs are the ones to go. You also need to be mindful, and this is a bit counterintuitive, but for some people, being cash flow neutral and not saving is actually not a bad thing. Because as Robert mentioned in his zero-sum game point, that if you have the same amount of cash in your current account after every 12 months on an ongoing basis, you might feel, oh my God, I'm running to stand still. I'm working hard. I'm doing all this and I don't have any more money in my account, so I'm not making any money. But actually there might be 2 things happening that you're not really aware of. One is that the principal on your mortgage is reducing every year. So if you're paying, 30 grand off your mortgage every year, your capital position is increasing by 30 grand every year because your debt is reducing. And also the JLL pension scheme, means that the money you're putting in and the employer is putting in is boosting the value of your pension. So I remember first did this exercise about 5 years ago for someone who said a couple were cash flow, we're paying tax at 52% and we're not, we're earning good money, 2 incomes coming in and we're not seeing any more money. And their actual capital position was increasing by something like 60,000 per annum just because of the debt reducing the mortgage and the capital of their pensions going up because of contributions. Just be mindful of that as well. So when you are maybe struggling from a savings point of view, consider what's happening with your capital and what costs are. Another question here is on, okay, 2 or 3 questions actually on mortgages and what mortgages. Now we do have my brother Joey, who's an expert in mortgages, coming in on the 6th, so it's only 6 weeks away to speak specifically on mortgages. But obviously there's a lot happening at the moment with the ECB increasing their rates from July, and you will see the available rates from all the banks, variable, fixed, are going to start increasing. It's difficult to know, to be honest, whether you should go on a 10-year fixed or a 3-year fixed or 5-year fixed or whatever it is, or whether you should go variable, unless knowing your specific financial situation. But I do think that irrespective of what mortgage, you need to look at, do you have a mortgage? Are you locked in? Do you have the option to switch it? If you do have the option to switch it, maybe now isn't a bad time to look at fixing potentially for 10 years, depending what the best rate is or depending what your preference is. There's trade-offs with it. I do think it's very, very important because we could see aggressive hikes in interest rates over the next 6 to 12 months. And it could go, at the moment, the base deposit rate for the ECB is -0.5%. We could see that going up by 2.5% in the next 12 or 18 months. So where the base rate then becomes 2% for deposits, but obviously the tracker rates on existing and variable rates are depending on a slightly different interest rate, but they'll all track the same way. So I think it is a very important decision. Obviously, it's very difficult for us to give an answer without knowing your specific circumstances. One other question here on where do we see investment markets going and where do we have any tips on investing? I would say that your best way of investing is through your pension. So when money is going into your pension every single month, and this is where getting the online access and understanding what funds you're investing is so important, because the more money goes into your pension, the more risk you're taking and the more you're investing. It's the most tax efficient way of investing is through your pension because there's no income tax on dividends or capital gains tax on gains. So everybody here has a pension through JLL, and that should first and foremost be the structure that you would use to invest. I'm not sure, do you have any comments on that, Robert?
Yeah, I would definitely agree with you, Jonathan. Because of the tax efficiency, because of the reliefs, and because of the the diversification in terms of the funds available to you as well, it's a very good option to take. So I wouldn't disagree in that terms. Definitely not.
JLL, thank you for your time. There's lots of you on this call. I really appreciate it. I know Robert appreciates it. Please do tell all your colleagues. I know some people weren't able to make it this morning. These are running every single week. We would love for you all to attend live again next Friday. Tell your other colleagues next Friday, cash flow planning. It'll be really, really exciting and interesting. We can't wait for it. Thank you for coming along this morning, and we look forward to seeing you all next Friday morning.
Thanks, guys.